Up and down and round, the economy roller coaster continues to be a turbulent ride only suited for strong stomachs. Let's take a look at what happened this week. Before we begin, remember to like this video and subscribe for more economic updates. The first piece of data came out on Monday with the release of the Institute for Supply Management Services Purchasing Managers Index for July. ISM reported that services PMI last month measured 51.4, 0.4 of a point better than the estimate and more than 2.5 points higher than the June reading. The number is a sharp contrast to ISM's manufacturing PMI, which tumbled to 46.8, deeper into the contraction territory represented by the index readings below 50, and the lowest level for manufacturing PMI in 8 months. According to analysts, it was the latest manufacturing PMI figure that helped spark the market's recent sell-off. On Thursday, the Labor Department released its latest report on initial unemployment claims. Last week, claims for unemployment benefits landed close to a one-year high, which played a significant role in triggering recent market turbulence. This week, markets breathed a collective sigh of relief as new claims numbers suggested the labor market might not be on the edge of a cliff after all. On Thursday, the Labor Department reported that new claims fell from 250,000 the week ending July 27th to a one-month low of 233,000 the week ending August 3rd. The drop by 17,000 was unexpected to economists who had projected that claims would come in just slightly lower at 245,000. Some analysts suggest that what's really going on is that businesses are not doing as much hiring as they were, but are not doing a lot of firing either. That suggests the possibility a previously ultra-tight labor market may be normalizing rather than preparing to fall apart. It was announced on Thursday that mortgage rates fell to their lowest level in more than a year. Freddie Mac reported that the average rate on a 30-year fixed-rate mortgage dropped to 6.47% from 6.73% last week. A year ago, the average rate on a 30-year fixed-rate product was 6.96%. Economists say the relatively sizable rate drop in just 1 week is a reaction to the mounting expectations the Federal Reserve will cut interest rates by at least 25 basis points in September. That's put downward pressure on long-term bond yields, which in turn has pushed down mortgage rates. Currently, traders say there's a 100% probability the Fed will reduce rates next month, with a majority now betting the central bank will cut by 50 basis points. Finally, more causes for concern in the realm of consumer credit emerged this week with the release of the New York Fed's quarterly report on household debt and credit. The report shows that total household debt in America grew by 0.6 of a percentage point in the second quarter to reach $17.8 trillion, another record high. Included in that whopping total is a $77 billion increase in mortgage debt and a $10 billion increase in auto loan balances. But as daunting as those figures are, the real low-light numbers of the report are those having to do with credit card debt. Last quarter, credit card debt increased by $27 billion, bringing the total to a record $1.14 trillion. Unsurprisingly, the report revealed that credit card delinquency rates are on the rise. 7.18% of borrowers fell into serious delinquency last quarter, a year-over-year increase by more than 40%. That's it for now. Join us again on Monday, where we hope next week won't knock you around too much. This is Devlin Steele for Augusta Precious Metals, signing out.